Hi, my name is Jim and I was retired. I suffered a little spreadsheet stress this week. Last week I introduced my Google site and promised to share some of the spreadsheets from past videos. Well, I've learned that Google doesn't play well with Apple. This week, follow along as I go about translating numbers into Excel. Dagnamit! Now, in my last video, I introduced my Google site and I showed you how I plan to share spreadsheets and PDFs and web links from the YouTube videos all in one central spot on this Google site. I was retired. Well, I introduced a few of the more mundane spreadsheets, including the most recent one. That proved challenging enough, but I thought I'd tackle the two main spreadsheets that I've used in these videos. One is the Portfolio by Buckets spreadsheet, and I'll show that to you. And the other is my D.I.Y. Retirement Withdrawal Strategy spreadsheet. That's the one that's caused the most stress this week.
So the first of the spreadsheets that I'll talk about this week is the Portfolio by Bucket spreadsheet that I've used to manage asset allocations across all my buckets. The 3 time buckets and the 3 tax buckets. And I'll put a link above to the first video in that series. And now, since it's been about 6 months since I introduced this spreadsheet, I updated the sample Quicken data a bit. Now, I've only updated the column F for market value to represent about 6 months worth of growth. So the couple now has about $1.1 million in assets compared to April's value of about $1 million. All the other columns I've ignored. I've assumed that they've kept the same assets and all of the asset allocations are going to be pretty similar. No, this is not my data. I've gone in, I've taken my data, I've masked it, and calculated a new value to give you something approximate to the asset allocations that I have in my portfolio. Now, this spreadsheet, including the sheet here for allocations, worked like a charm. It translated very well. The formulas are pretty simple, and so it transferred from numbers to Excel pretty quickly. And again, I'm not going to devote a lot of time to this because you can go back to my past series on how all of these spreadsheets work and the components. But the values come down here and it adds up the asset allocations, first using asset mixture and then breaking the asset mixture into large cap stock and domestic bonds to give me the asset allocation of all of my assets, and then comparing that asset allocation against a target allocation. I will note that down here in April, I was using a 110 minus age for equity in the ratio of asset allocation. And since then, I've decided maybe I should be closer to a 60-40 asset allocation, particularly as a pension starts this year with a fixed income stream. I'm no longer relying as much on the bond portion of my asset allocations. Maybe I should be taking a little bit more risk. That's something I haven't worked into the formulas here. You can think about it as you adapt this spreadsheet for your own. Now, I'll talk more about this block on the compounded annual growth rate in my next discussion on the next spreadsheet, but I've added that here as well. The 3 buckets works very much like it did in the demonstrations over the managing my assets over my tax and time buckets. And it gives you a breakdown of your assets in the 3 buckets, as well as a breakdown of your asset allocation over your tax buckets. And again, a quick refresher, go back to the videos if you need more, but the time buckets are about 1 to 3 years in bucket 1, 4 to 9 years in bucket 2, and everything beyond 9 years in bucket 3. And in the tax buckets, you're talking about taxable accounts, savings and brokerage accounts, tax deferred, where most of your assets are in the tax deferred accounts in retirement savings, and tax free are your Roth accounts. So all of these formulas work the same as the prior video, so I'm not going to spend any more time on this spreadsheet. The more challenging spreadsheet was this one, the Retirement Withdrawal Strategy that I introduced in my D.I.Y. Retirement Withdrawal Strategy series. This one took a lot more effort because of the number of sheets and the complexity of the formula, but also because I've introduced some enhancements to this that build on some of my more recent videos, including the tax situation scenarios videos that I most recently did. So I'm going to go through carefully what I've done here in the version that's up on my Google Sites. And I'll begin with this down here with the compounded annual growth rate calculation box. My numbers version of this did not translate into Excel because I was using functions like text after to get the date of the data from Quicken. Text after? Ich nicht verstehen, says Excel. So I had to go through and find the right formulas. I ended up using, as this one shows here, up here, date value right, count the 10 characters to the right of that cell and get the date. That's how that worked. The other formulas seemed to work. The year frac worked, and this formula here to do the calculation with a rate formula to do a CAGR compounded growth rate estimation worked out well. So that worked. So I've updated this one. Then I also introduced this block here that really came from my reading and following the work of Wade Pfau and the retirement researchers to come up with a net present value of current assets, future assets of income streams, and future liabilities to give you a current funded ratio. Now, this is just a snapshot, and so because I went through that workshop, I built this into the process. And this is using calculations here to give you a present value of the income stream from Social Security and the spouse's Social Security and the pension that are on this input sheet. And that all adds up into the total present value of those assets, your current Quicken assets, plus these calculations. But then you have to give some present value to your liabilities. And this is using a calculation from the main sheet tax summary, which I'll get to in a minute, as well as a present value of the income spending that you expect to do over the next 35 years of about $60,000 before inflation of expenses. That adds up to a current funded ratio of about 136 for this sample. Now, the main sheet is where a lot of changes happened. I had to make sure that all the calculations were working as expected. And again, it's using data from the Quicken values to bring in your current year standings of assets. And then it has columns for your income fields. And here's where it really went bonkers. The calculations here had to be precise, and we had to make sure that it was all accurate. But I also ran into some problems with Excel because sometimes if I tried to copy and paste a style, a number style, wow, I got a lot of different pictures. Let me show you some of them right here. They were just wacky. I would think I was getting it correct, and all of a sudden, particularly the blanks, would all of a sudden show up with hash marks. It was bizarre. I know sometimes the hash marks indicate the margins aren't wide enough, and you expand them out and it works. But these were just wacky. And so it was an annoyance causing a lot of stress. All of the other columns here on earnings work pretty much the same way. The big changes in the spreadsheet main sheet was how I calculate taxes. Back in earlier videos when I introduced this, I was doing this real rough, take a look at your federal brackets and your state brackets and add them together and give you a real rough approximation of taxes. And I've broken this down into separate columns for gross income, taxable income at the federal rate, the federal rate, the state taxable income, because that is going to change depending upon your state. Here in New Jersey, with a exemption for retirement income, that was important. Giving a state rate. So I estimated the two taxes separately with very complex calculations using VLOOKUP, because XLOOKUP doesn't work in this version of Excel and in Google Sheets. So I had to change these formulas. That then gave me a combined rate and a combined estimated tax. That's the figure that used to be called estimated taxes. Now I've added that to the expenses and looked at the shortfall. Now, I have not gone through here and done the final step and really get these to be as narrow as possible so that you're saving or putting the excess into brokerage, which increases interest and income off the brokerage or savings. I haven't done that. It's a process I walked through in a prior video. You can play around with it if you'd like. So it does come down here as the prior worksheet did and give you a calculation of combined taxes. It totals $754,767 in state and federal taxes over the retirement of this sample couple, with an average annual taxes of about $19,000. That's the calculation that you need, the average annual taxes, to come up with a present value of this future liability of taxes on the input page. Then I had to copy this sheet with its new columns on taxes and move it out. So I copied that sheet and then redid what I did in the earlier worksheet of coming up with a version that eliminates RMDs for the tax deferred accounts by taking big amounts out early. And I created another one here, another sheet like I did in the previous workbook on the D.I.Y. retirement withdrawal strategy, where I took the main sheet, copied it, and then left it so I was only taking what was needed to balance for expenses and taxes that year. So only taking what I needed until the RMDs, and then took the RMDs and only the RMDs. And that presented another tax scenario. I did not modify this sheet. This is the old format. And if you want to do modeling of some Roth conversions on this retirement withdrawal strategy, you're on your own. Take the main sheet, copy it, and then do something similar to what I've done here. You can go through the sheet and do something similar where you're taking out more than you need for expenses and converting it through a Roth conversion with a deposit in this column instead of withdrawal. And that adds up here. It moves up a series of Roth conversions. This is that big one that from past videos you know is my Roth 401k. You need to get that out into a Roth IRA before the age of 72, or you're required to take RMDs from your tax-free Roth 401k. Yep. The other thing I did this week, because news broke, was we have new 2022 tax brackets. So I went, as I did those complicated tax columns for federal and state, on the federal side, I went and updated the matrices. I'm using what's over here. Standard deductions calculate to give you a standard deduction plus one person is over 65. These formulas here work. Plus, I've now introduced the new 22 married filing jointly tax brackets that are fresh out of IRS, including the base tax. As I learned in my last couple videos on tax scenario planning, the tax brackets are a little bit more complicated than most people think. This now uses a more complex formula to come up with a better estimate of your federal tax exposure. Income over the 12% tax bracket into the 22, you're only going to pay 22% on the stuff that's in that bracket, plus the base tax. So this is all there. I've also added, and if any tax accountants are out there, this is my estimation of 2026 brackets, where we will revert to previous tax brackets. So I've tried to estimate what those will be plus the base tax. I'm not sure it's accurate, but I've made some modifications. The big change is the standard deduction is going to get cut in half in 2026. Now, I'll put a link to the IRS PDF that has all of the new tax information for 2022 down below in the notes. This is the formula for the retirement exclusion in New Jersey. Again, different states have different rules. You'll want to do something to calculate and figure out what your state tax exposure is for all of your retirement years. This is what I'm doing for New Jersey. Now, I've left in, and I've really not modified this much, this is the simple chart that you can use to link up to the scenarios that you create. And it's very simple. I've already done these two columns here. This is now pulling from that main sheet, that column of combined taxes, and pulling it down. And this one's coming from the new eliminating RMDs by 72 sheet. And this one's still coming from the old Roth conversion. So whatever new scenario you have, you can direct it to get the cells on that column, pull it down. These three columns all will be running totals. They pull from these, and it'll give you this chart over here. Let me show you quickly the Google site and where you'll find these spreadsheets to download. You take a look at the website up here. It's sitesgoogle.com view/I was retired home. Now, where do you find the spreadsheets? They're on the resource pages, spreadsheets. And go to the bottom of this page and you'll see that there's these two spreadsheets that I've just added. The portfolio by bucket spreadsheet and the D.I.Y. retirement withdrawal strategy in Excel. But once you get to the spreadsheet here, you just want to click here to pop out and do it that way as well. But you should be able to go in, download it down here, download the file, and you can play with it. Again, give me credit if you find it useful. Let me know how it works.
I hope these two spreadsheets help you. You can find them on my Google sites. Download them, play around with them, and see if the formulas work for you. Please comment below if you have any suggestions on improving them. Let me know if the links work, and let me know if the formulas work for you too. I will close with my standard warning. I am not a financial professional. I have no special initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out professionals if you need to. Oh, and did you subscribe? Please like and subscribe to this channel and hit the notification bell and you'll be notified when I post my next video.